As of July 2022, inflation is over 9%, and the markets are super volatile as people are bracing for the potential of a recession. In fact, polls have shown that 58% of Americans believe the US economy is already in a recession. So in times of market volatility and high inflation, what should you do with your cash? Should you be increasing your savings in the event of a downturn, or should you be investing more money in a down market? There's not one good answer to these questions, but in today's video, we'll be talking about the reasons holding cash can be a good idea, but also why too much cash might not be great either. So let's get started. All right, so I went to Costco the other day and was super excited to visit the food court after shopping. Who isn't? Who doesn't love the dollar hot dogs? That excitement though turned to sadness when I realized that Costco raised the price of the chicken bake by $1. $1. I mean, I get it. Chicken prices have increased 24% over the past year, but that one hit me hard. Realistically though, even during non-inflationary periods, the prices of goods and services do go up over time. Price increases are just even more noticeable in 2022, more so than ever. This means that every single year, the purchasing power of your paycheck and your savings do decline. It just seems more evident right now. Here's an example of this though overall. Let's say that you purchased a TV in the year 2000 for $1,000. They cost a lot back then. If you were to purchase that same TV today, it would cost you $1,720, a 72.1% increase. While holding cash is not necessarily a bad thing, you cannot ignore the negative impact inflation has on your cash simply due to the time value of money. We all know that investing is one of the best ways to preserve and grow your money over time. If you didn't know that, watch some more of my videos, so hit subscribe. But does this mean that you should put all of your available cash into investments because cash is trash? Not quite. The debate about whether cash is trash or a king has long been debated. And while this sounds counterintuitive, cash might actually be king in today's economy, even with inflation running wild. If you like this video and want to see more of our content, hit subscribe right now. We'd really appreciate it. If you check on your investments way too often, like I do, I tell people not to, but I do it, trust me. It's scary seeing your portfolio drop in value. We're seeing some ugly stock market and bond market returns this year in 2022, and there's no clear sign as to when this bear market might end. Now, holding some cash on the sidelines can be helpful both as a cushion and for some as a useful tool for when they see buying opportunities in the stock markets. And with fears of an economic downturn rising and the market in turmoil, having cash on the side can serve as your personal safety net during this time. And with that, having emergency savings with at least 3 months worth of savings is a key step towards building financial wealth and security. In fact, many people, including myself, say that your emergency fund should be prioritized before focusing on investing. Maintaining that emergency fund can also keep your financial and savings goals on track, even if you lose your job, experience a change in income, or run into large unexpected expenses. Imagine if you get laid off and didn't have enough cash set aside to cover your living expenses for a few months. What would you do? Chances are you would need to sell some of your investments to cover your living costs, assuming that you have investments on the side. Since unexpected shifts in income, such as layoffs in this case, tend to occur during downturns in the stock market and economy, it's possible that you'd then be forced to sell your investments at an even worse time, when the market is super low. Talk about buying high and selling low. Don't do it. The money that you invest should be money that you don't need for your day-to-day expenses, and you'd like to let grow over time. We say at least 3 to 5 years in the future. A solid emergency fund can also save you from putting unexpected expenses on a credit card or taking money out of your retirement accounts, likely saving you from paying taxes, high interest rates, penalties, and taking away from the power of compounding. Since this emergency fund is designed to be used for, well, you get it, emergency situations, you should have money set aside in cash to cover unexpected expenses. Remember that this is cash savings we're talking about, not investments. You want this money to be liquid and easily accessible if something big, unexpected happens, like an emergency. So how much should you have in this emergency fund? Well, if you don't have an emergency fund at all right now, I would total up what you spend in an average month and then multiply that number by at least 3, although 6 is much safer. Having enough money on the sidelines to cover at least a few months worth of expenses gives you some peace of mind. If you only have one income, or your job is maybe less predictable, such as a freelancer or you have commission-based work, you may want to set aside even more than 6 months just to be safe. In this case, I guess cash is king. Now, if you don't know where to keep your emergency savings, you want to make sure that you're getting the most out of that cash. You got to earn the most. You want to earn a high interest rate, you don't want to pay any account fees, and you want to be able to access it quickly when you need it. It's your money. And you also want the peace of mind that your money is safe and secure. And with the Federal Reserve continuing to raise interest rates, the rates some banks pay out on cash will also increase. Typically, online financial banks or institutions offering savings accounts will pay a higher rate than the traditional brick and mortar banks. According to FDIC.gov, the average savings account rate sits at about 0.08%, while the average online savings rate is near 1%. At Wealthfront, our cash account offers a high APY on your savings, which is almost 20 times larger than the national average. Our cash account also has unlimited fee-free transfers, which many traditional banks don't have. If the bulk of your savings is still at a traditional bank, making next to nothing, you should explore getting more interest out of your money that also gives you full flexibility to access your cash whenever you need it. Again, it's your money, you should be able to access it. Okay, so we talked about emergency funds and why you should hold some cash in high-yielding accounts. Great. Does this mean you can now unload the rest of your money into the stock market and other investments? Hold on there, not quite. For most people, the absolute minimum amount of cash that they should keep on hand is their emergency fund plus some extra cash to cover their regular expenses for the next month or so. But for some investors, holding extra cash is a calculated risk they are willing to take. Now, this is a contrarian thought here, but hold on here. A study surveying wealthy investors worth $30 million or more found that on average, they held about 23% of their portfolio in cash. That seems super high enough to where it could eat into your returns, right? Not exactly. I mean, it would for some, but while holding cash in a portfolio can theoretically reduce returns as the markets go up over time, it can. It's also relatively stable value could also serve as an anchor for a portfolio when the market goes down. For example, a 20% market decline in a fully invested portfolio results in a loss of 20%. With a 20% cash position, the same market decline results in a portfolio loss of only 16%. But that's not all. For some wealthy investors, holding large amounts of cash is worth it because if or when the economy enters a recession or economic slowdown, that cash might allow these investors to buy up some cheap homes, stocks, and other assets that are on sale. Here's a great example of this. We all know Warren Buffett, right? The legendary investor that runs Berkshire Hathaway. Berkshire is a fundamentally driven company. They only invest in companies that really meet their requirements and expectations. But they're also known for having the ability to do deals when everyone else is strapped for cash. Back in 2008, everyone was super scared and racing to sell their investments. Meanwhile, Warren Buffett was on a calculated shopping spree. In just 2 months, Berkshire bought over $15 billion worth of stock. In fact, he was able to save Goldman Sachs and General Electric from going under, while also helping finance some acquisitions. These investments during peak fear could have only been possible if Warren Buffett had some extra cash. Flash forward to the present day, what do you know? Warren Buffett is pretty much doing the same thing now in 2022 that he did in 2008. In the first quarter of 2022, Berkshire spent roughly $50 billion on stock purchases. Even after these purchases, it still holds over $100 billion in cash. And as Warren Buffett puts it, we would die psychologically if we lost a lot of other people's money. So the one thing I can tell you about Berkshire Hathaway is that we wake up every morning and we want to be safer. So, according to Buffett, even if the markets continue to swing up and down and experience high volatility, the thing that they won't change is that they'll always have a lot of cash on hand. So we've talked about and seen both the pros and cons to holding cash. We know it's important to have at least some cash saved up for emergencies. But when it comes to any excess after that, it's a tough call. It depends on the person and your risk tolerance. Whether you're investing close to 100% of your money or holding large chunks of cash waiting for the next economic downturn, there are inherent risks either way. Personally, I like risking it. I like having all of my money invested, but some people might benefit from the ability to not fully experience market downturns with some cash on the side. That being said, thanks so much for watching. Be sure to subscribe to the channel, and I'll see you in the next one.